Hello and welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
Here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We have some profit taking, some worry about peak sales. I think we'll have a reversal and the stock will rebound based on the remarks from CEO Jensen Huang on Wednesday morning Pacific time.
Former President Trump has obviously positioned himself as the candidate that is pro-Bitcoin. He believes that all Bitcoin should be mined in the U.S. and has been very open in his relationships with Bitcoin miners and people in the space. The Biden administration has been very hostile to Bitcoin, through its various agencies, whether it's the banking and the so-called Operation Choke Point 2.0, whether it's the SEC, et cetera.
Back in 2016, she described what she called the high-pressure labor market. And maybe if you ran policies such that you have a high-pressure labor market, some companies would be incentivized to invest, and we could actually see a boost to productivity. So I would ask her, Secretary Yellen, do you think you're seeing the dividends you expected to see from running a high-pressure labor market, a more productive, efficient, resilient economy? Is that part and parcel of the policies that were chosen during the pandemic?
And indeed, we'll be asking her that and more. Treasury Secretary Janet Yellen, in a national exclusive here on Yahoo Finance, the Treasury Secretary of the United States. She'll be discussing a new slate of initiatives to support housing development and much more in conversation with our Jennifer Schonberger. Well, in the meantime, we've got 1 hour to go until the market close. So let's take a look at the major averages here. We've got the Dow today up almost 300 points, about 0.75%. The S&P 500, little change though. And the outlier today, Josh, is the Nasdaq Composite. And there is one stock in particular that is the culprit behind that and that we're really zeroing in on. And that stock is Nvidia. The stock is down about 5.1% today, but we've now seen this sort of 3 into 4 day sell-off here, call it 3 days that we've seen this decline of 11%. Which is the biggest sell-off that we've seen in the stock, in at least 6 months or so. And I also just quickly wanted to point out what we're seeing in the market cap race here. Microsoft's back on top, 3.3 trillion. Apple, 3.2 trillion. Nvidia below 3 trillion now.
Yeah, I mean, if you pulled up a chart of Nvidia and you looked at, of course, at that year to date, Julie, it is, of course, it's just been a historic run. It's a monster. So I get, investors are, I think, trying to figure out, do you see here what you would expect? I mean, look at that chart. What you expect to see, which is sort of like kind of a healthy consolidation. Is that all we're seeing here after a run like that, or do you think it's the start of something a bit more serious?
Yeah, that's really the question that people are asking. And they're trying to look out further for Nvidia. Of course, with anything, the further out you get, the more difficult it is to predict. But there's some chatter that with Nvidia, it is uniquely difficult to predict because it's really a new market, this whole market of AI for data centers here. And so something that I have been looking at a little bit too is the valuation here. This is something that Bloomberg flagged today. The price to sales ratio for the S&P, for the Nvidia is actually the highest in the S&P 500, which I found quite surprising. The price to earnings ratio at 45 is nowhere near the highest. And it has been creeping up, but some analysts say it's still reasonable. But price to sales, because the sales is really the unknown. Are they going to be able to keep up this pace of sales growth that they have been seeing?
Yeah, and then you have a kind of broader questions too, Julie, about do you think the market can keep chugging higher even as a king like Nvidia takes a breather, right? Can you hand off the baton from Nvidia to other names smoothly? I mean, so far, you pointed out that chart of what it's done recently, and it has been a slide, but it's not as though so far the market seems to be, falling apart here.
Yeah, no, it doesn't, right? Even with that stock pulling back a little bit, the Nasdaq has taken a hit as a result of that. One more thing I would mention, we just heard Paul Meeks a moment ago talk about a possible catalyst for Nvidia shares from its shareholder meeting. That is tomorrow. Now, shareholder meetings, the Tesla recent one aside, are not typically news-making events, right? And Nvidia is not expected to necessarily make any announcements. But if Jensen Huang gives one of his sort of typically rousing speeches, could that be an excuse, a catalyst of some kind to turn the stock around? Maybe.
Yeah, I mean, all attention will be on that. You're right. Usually, it's not a lot of news, but you have a rock star like Jensen Huang speaking. Who knows? All right, let's broaden out this discussion for more on the latest market moves and the path ahead. Let's welcome in Art Hogan. He is the Chief Market Strategist at B. Riley Wealth. Art, it's always good to see you. Let's maybe start a kind of broader question, Art. You know, Julie was pointing out today, you look at the SPX, S&P 500, we're basically flat today, Art, but what a run. It's up about 15% so far this year, Art. I'm just interested, do you think that does that rally continue in the second half, Art, or no, you'd expect us to take kind of a breather here?
I think today is a perfect example, and I think you guys set this up really well. I think it's a perfect example of a lot of folks being concerned that Nvidia, and arguably Nvidia, Microsoft, and Apple were such a big part of the 15% that the S&P 500 is higher this year on a year-to-date basis. And what would happen if one of those really fell out of bed? Now, not that 10% down on a stock that's up 140% year-to-date, minus that 10 is a big fall. But you're seeing, basically 3 or 4 days where Nvidia has not been leading the charge, and the market's done very well. I think that continues throughout the second half of this year. I think what we're going to see is if you look at the cadence of earnings growth, the percentage that the other 497 stocks in the S&P 500 are going to be adding becomes much larger. So I think you're going to see the market broaden out and likely see things like energy, which we're seeing today, financials, which we're seeing today, utilities to a certain extent, and likely industrials. To your point, Josh, pick up the baton a bit and start pulling their weight in terms of what happens in the back half of this year. And I think that puts us in a healthier place. I think the concentration at the top obviously has people nervous. And if in fact we work our way through the second quarter earnings reporting season and see other sectors shine, which we did in the first quarter, we saw the sectors other than technology actually do very well. I think this market can really pick itself up in the back half and not necessarily need to be driven by tech and communication services.
Art, does that then imply also that you're pretty optimistic about growth, right? Because obviously the tech increases that we've seen have been boosted by this AI narrative. But for everything else to do well, it just kind of has to be a general growth narrative, no?
Yeah, I would agree with that, Julie. I think when you look at the estimates for the second quarter GDP growth, according to the Atlanta Fed, GDP now, it's north of 3%. We'll get another revision to the first quarter later this week. I suspect that goes higher, not lower. I think we're going to be on pace to not necessarily have that sort of 3.5% GDP growth that we had in the back half of last year, but something like 2.5%, which is certainly above mean and likely enough to be driving profits. So if you look at the earnings estimates for the next 3 quarters, including the second quarter, they gradually work their way higher. And as we all know, that the consensus tends to be a bit low. So I think we continue to see both the economy and earnings grow outside of consensus estimates into the end of the calendar year.
Another catalyst, a potential catalyst, we're watching this week. PCE is on deck, Fed's preferred inflation gauge. What are you expecting to hear there, Art? And what are you expecting from the Fed for the remainder of the year?
Yeah, I'll tell you this. The PCE is a little easier to calculate because by the time we get both the CPI and the PPI, we know what pieces of that goes into that PCE reading. So as opposed to the 2.7 at the core level, we'd like to see that go down to 2.6. And oddly enough, that's where the Fed had actually factored us exiting 24. So we'll be seeing a 2.6 print on the core likely this week. That 2.6 is going to be close enough for government work for the Fed to actually feel comfortable enough in September for their first rate cut. And I think that is likely going to be the start of feeling a bit better about where we are in the monetary rate cycle. We're going to be kind of last to the party as that goes because as we know, the ECB already made that move. The Bank of Canada, the Bank of England leaned into it and likely goes at their next meeting. So by the time September rolls around, we will likely see the Fed cut for the first time, and that probably takes a little pressure off the dollar too. The dollar's been unidirectionally higher since the Fed seems to be dragging their heels to the rate cut party.
I want to just push on one angle there. The Fed, it seemed like there was a moment in time there where it was just Fed all day, every day. Fed. And it feels like maybe it's pulled back a little bit on that. I mean, am I imagining things, Art, or is the market or investors coming around to the idea that maybe we're not as dependent as the Fed as we thought we were 6 months ago or 12 months ago?
Oh, absolutely. Such a good point. Yeah, so the Fed pivoted. They leaned into being done with rate hikes at the end of last year, and gradually, and so we entered this year thinking maybe we get 5 or 6 rate cuts and they'd start as early as March. And that dissipated pretty rapidly through the first quarter, and yet the market continued to rally. So investors have really shown that given the choice between early and often rate cuts and better economic data and earnings, they choose the latter, and I think that's a very intuitive choice to be making. So I think market participants have certainly leaned into the direction of we'd rather the Fed not have to cut, but if they do cut, they can take their time doing it. And if September is the first time they do it, that's going to be great, as opposed to where we were when we started this calendar year, which was assuming they were going to be cutting a whole lot more. And the good news is they didn't have to, because the economy continues to chug along at an above mean pace.
Well, of course, we always have monetary policy on our minds, but lately we also have fiscal policy on our minds, right? As we talked about, we're going to be hearing from Janet Yellen a little bit later in the show. We've got the debate coming up later this week. Do you have clients asking you about the situation in Washington? Are you seeing more of a drumbeat for that? And what are you watching in terms of how it might affect the markets?
Now, I would tell you, when it comes down to fiscal policy, the hardest time to talk about that is an election year, because neither side of the aisle is going to actually ever say anything about cutting spending. And we need to do both. Obviously, we're in a place where our debt is too high, and it's a function of two things. We need to collect more revenues, and we certainly need to spend less. And so fortunately or unfortunately, we're not going to resolve any of that. But after September 30th, we're going to have to start coming to some sort of agreement on what next year's budget looks like for the fiscal year. And clearly, there's going to be no new spending, and there's likely going to be a push to rein in some spending. But there's two sides to this sword, right? And the other side, obviously, is we need to find some revenue generation, whether it's better economic activity or simplifying a tax code, et cetera. So I'd be listening to people that are willing to talk about both sides of that equation. Unfortunately, in a national election, nobody wants to talk about cutting spending.
Well, and we're probably not going to hear it on Thursday night from the two presidential candidates, most likely, because that's not going to get them any votes. But what would you, in that debate, what would you like to hear come up, or what are you going to be listening for in terms of any kind of direction on economic policy or tariffs, or what do you think could be most important?
Yeah, I would like to have a clear and concise argument made for why tariffs actually work, because I don't believe that they do. I think at the end of the day, it's the end user or the consumer that pays that tariff. So I just think it's bad policy. I certainly understand how that worked 100 years ago, but in the global economy that we live in, those costs are passed along to the end user or the consumer, and that's inflationary. It's higher costs. And there's not a real benefit to it. So I think that's one piece of the puzzle. I think it'd be a great brick in the platform for both of these candidates to remove and say that's probably not the right way to go about this. You could certainly protect American industry without costing consumers more money, and that's one thing I'd like to see get rid of. But I certainly would like to hear a real serious conversation about what is the best way to both find ways to cut spending, right? And what are the best ways to generate more revenue, and what ways would make that sense? And I think that from the Democratic side, they really talked about putting more people to work at the IRS, because there's a lot of people at the upper end of the economic scale that tend to pay less in taxes and perhaps get away with that. But I think simplifying this tax code would go a long way towards saying, okay, we would probably raise more revenues and make things more fair if we simplify the tax code. Again, election year politics, you're likely not going to hear either one of those things come up on Thursday.
You never know, Art. Hope springs eternal here when it comes to the American election system and political system. Thanks a lot. It's great to see you.
Good to see you.
We're just getting started here on Market Domination. Coming up, Apple stock higher today as it looks at a potential AI deal with Meta, even as it is under fire in the EU. We're joined by an analyst later in the hour to talk about the latest from the iPhone maker. Plus, at 3:45, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into two stocks to help you make the best moves for your portfolio. And stay tuned for our exclusive interview with Treasury Secretary Janet Yellen. That's at 4:40 p.m. Eastern today. She'll be discussing a new slate of initiatives to support housing development. Stay tuned. More Market Domination on the other side. As Apple has set its sights on AI growth, the European Union has its sights set on the tech giant itself, charging the company for failing to comply with a digital competition law. Could this take a bite into what's ahead for Apple? For this and more, let's get to Bob O'Donnell, Technalysis Research President and Chief Analyst. Good to see you, Bob. Thanks for being here. So let's get to that EU law first, right? Because this is the first case that we have seen been brought as part of this Digital Markets Act. It has to do specifically with what the EU is charging as unfair restrictions on developers in the App Store. And it could result in a fine for Apple. How seriously should folks be taking this?
Well, I mean, look, Julie, it's going to take a while before any of this hits. I mean, they announced that we're looking at it. They opened the investigation in March. They give themselves a year, which means there's no official word on part of this until March of 2025. So nothing right away. But look, I mean, Apple made some changes at the beginning of the year in reaction to, the changes that we knew were coming here in the EU. But there were a lot of people saying, look, you may have followed the letter of the law, but not the spirit of the law. And I think that's what's kind of coming back to them is people saying, look, you're not really making it easy for these smaller developers to really be able to get access to this huge bounty of iPhone users. And Europe is last quarter, it was about 25% of Apple's earnings. So this is a big market for Apple. And Europe is setting the standards as far as how companies have to think about providing access to alternatives like, different app stores and things like that. Apple's always wanted to keep a closed garden. They've done it very successfully up till now. But the EU is basically saying, you got to open it up a little bit more and not just exactly to the letter of the law, but to the spirit as well. And I think that's essentially what the concern is.
And Bob, though, when you look at investors, how they're reacting, I mean, they are taking this in stride. I mean, Apple is actually up about 0.7% in today's trade. Do you think investors, Bob, are they being too complacent or no? You think ultimately this is going to work out? Apple's going to, at the end of the day, make some tweaks that in some way make regulators and investors happy?
I think it's a little bit of both, Josh. I mean, bottom line is, again, it's going to take a while before anything immediate happens. So to react to the price, to the stock today seems like it would be a bit much. I do think Apple is going to have to make some tweaks, some things that they don't necessarily want to do. But at the end of the day, again, it's an important enough market that they're going to have to follow some of these requirements that the EU is putting into place. And therefore, long term, I don't think the impact is that big of a deal as far as the value of the company and the way people view the stock. I think there are other issues that are going to be important for Apple to deal with in Europe. And of course, this whole idea that they're not going to bring their Apple Intelligence features, their new AI stuff to Europe looks to be very interesting. You have to wonder, is there a little bit of chicken going on here? Like, hey, if you're going to take this away from us, then we're going to keep some of these features away from people in Europe. I don't know for sure if that's really the case, but you got to wonder if that goes into some of these decisions.
Right, and there has been some reporting to that effect, Bob. Let's talk about then the other sort of related story, because if they're holding back on AI features, and that's that they are looking to potentially partner with Meta, looking at AI. Now, I don't know if this is a big shock that Apple sort of is casting a wide net when it comes to its AI development. What do you think?
Well, the biggest shock, honestly, was the fact that Apple brought in anybody. And then, of course, they announced with OpenAI as being integrated into Siri, which is very interesting because, the implications of that are that the entire Siri experience isn't controlled by Apple. I mean, of course, yes, they give you the warnings, et cetera, et cetera. But I think, there's a couple things going on. Number one, immediately, even at the event itself, they admitted, yeah, we're talking to Google too, as some of the reporting that, we've seen other people talk about say. And then, so it's not a surprise at all that they're going to talk to Meta and some of these other big AI firms. The bigger question to me is, how is that going to actually play out? If I'm an end user and I'm using these Apple devices and I want to use these Apple Intelligence features, will I make my choice between, ChatGPT, OpenAI's ChatGPT and Google Gemini Pro and the Meta Llama stuff? Or is that going to be a little bit controlled by Apple, or will it be region by region? I mean, Apple's install base being as large as it is, any service that gets access to that install base, it's a huge benefit to them. So, Apple knows how valuable that is, and I think they're going to be very cautious in the manner with which they deliver those capabilities and in which companies are going to benefit from that. So that's, my big question mark there is like, hey, how is this actually going to work? And then again, ultimately down the road, are there going to be payouts involved? Initially, of course, it was reported that there aren't going to be any, but all these things can change.
It was interesting, Bob, just the fact that, reportedly Apple and Meta are even talking. I mean, these two have, they certainly had their kind of ups and downs, Bob, over the years. You think of issues like ad targeting. I was interested, though, also just kind of a broader question, too, Bob, because as you mentioned, so, Apple's partnering with OpenAI, and now we have these reports that are at least, talking to Meta. I wonder if it also tells you something about, as a tech analyst, about where you think the real value is going to be long term. Is it going to be in these LLMs, these large language models we talk so much about, or is that going to be kind of commoditized and the real value down the line will be in the application layer? What do you think?
Well, it's a great question, Josh. And, I think bottom line is we at some point are going to see commoditization of these big, large language models. And I think Apple is part of what they're doing. Part of that strategy is to say, look, we're going to make sure not one company gets all the eggs in their basket, because that would give them a lot more power and a lot more value. So if in fact they sort of spread the wealth, as it were, it does start to commoditize the value. Again, the question will be, how good is that experience? And you're right, that application layer, in this case, it would be Siri or other services that Apple lays on top of that underlying search engine. And, just as they did with Google for, Apple search, or for searching within with Safari and what have you, where does that lie, and where does that value lie, and where do these things go? Those are all questions that remain to be answered. A lot of people still investigating that, how these are going to work. I think it's critical that you do have some high quality large language models, and I do think some of the big guys are going to win, and they're going to profit from them in some way. But there's a question of degree. And is it going to be more based on the way that the large language model delivers its information, or the applications that leverage those large language models? And I think we're still going to figure those out. Apple clearly for now is going to focus on the application layer, but at some point down the road, you have to imagine they're going to have their own answer so that they don't have to go outside, because that's very atypical of Apple. And I think you're going to want to have them control the whole experience, as they typically have always done with all their other services.
Bob, always great to have you on the show, my friend. Thanks for hopping on.
Thanks, Josh.
Now let's get to some trending tickers on Yahoo Finance today. Target, start theirs, turn into Shopify to add new and trendier brands to its website. Starting today, companies that work with Shopify can apply to join Target Plus, its third-party marketplace. So that was the headline here that got attention, Julie. Target says, okay, we're going to partner with Harley Finkelstein's crew there at Shopify. We're going to offer this kind of selection of merchants and their products on Target Plus, which is their digital marketplace. It was interesting just to listen to sort of Target executives in their statements announcing this deal. They're really trying to hammer home, Julie, this kind of sense of curated experience for Target. Target Plus is sort of the thing they think that can make them different, perhaps, from some of the competition.
Well, to your point about curation, I didn't realize this. If you want to be a third-party seller on Amazon, bring it on, baby. If you want to do it on Walmart, bring it on. Target chooses it. It doesn't approve everybody, apparently, even though it can be a revenue line for the company. And because of that, at least in part, its third-party offerings are much, much smaller and a smaller piece of the business than they are at a place like Amazon or Walmart. And by the way, it's not just about the fees that these sellers pay to be able to sell on these platforms. It's also the suite of services they offer around it, marketing, in some cases shipping, although that's not part of the Target Plus services. So it's quite interesting, the ecosystem that has sprung up around these third-party sellers, and Target's trying to get like cooler stuff, it seems like, on their platform. That's one of the reasons that they're doing this.
I did not see financial terms laid out on this one, but listen, both these companies could also use a lift, right? I mean, this year Target's up around 5%. Shopify has had a tough 2024.
Yeah, definitely. Well, let's talk about another trending ticker today. And really tickers is what we're talking about, because we're talking about crypto here. And what we're seeing is a pullback in Bitcoin, but not just Bitcoin. Many of the other coins are down. Bitcoin itself having its worst day since March, and then you see the suite of Ethereum, even as we continue the drumbeat to approval of a spot Ethereum ETF, Cardano, Solana, Binance. I saw Dogecoin is down, the Shiba Inu coin is down, you name it. There seems to be a lot of pressure here. And this is on top of selling that we had last week as well. Some of what's going on here is just the ebbs and flows that we see in crypto. There is, however, remember Mt. Gox, that Japanese crypto exchange that got hacked into? It's now, as part of its whole process of recouping some of those losses, it's going to start apparently starting repayments of Bitcoin and Bitcoin Cash next month. We're not July yet, no, next month. And so that's putting a little bit of selling pressure on too.
Yeah, that's certainly adding to worries about selling pressure. Bloomberg pointed out, by the way, Bitcoin investment products really saw around 600 million in outflows for the second consecutive week, which was, they say, that was the most over a 2-week period since the U.S. actually greenlit those ETFs to hold the currency in January.
Well, yeah, and that's because there was all that money pouring in, and now we're seeing a little bit of a stalling out from that. By the way, the record for Bitcoin was almost 74,000 back in March.
Wow.
Yeah.
Moving on, Novo Nordisk announcing it will spend $4.1 billion building out a new facility in North Carolina to increase the output of its weight loss drug. Yahoo Finance's Anjali Kamlani joins us with more. Anj.
That's right. No surprise here. Novo Nordisk adding to the capacity that it needs for those injectable GLP-1 drugs, that's Wegovy and Ozempic, and it's doing it at the same time that Eli Lilly is. We know Eli Lilly also just recently did the ribbon cutting for its new facility, 1 million plus square feet in North Carolina, adding to the injectable output. Now, Novo Nordisk saying that this is a 4.1 billion investment for 1.4 million square feet, part of its goal to expand capacity by $6.9 billion of investment, and is an increase from last year of $3.9 billion. This will double the company's existing production capacity in North Carolina alone and in the U.S.
And then Senator Bernie Sanders today coming out, swinging a little bit against Novo Nordisk over the pricing of the company's drugs.
That's right. And finally, a date set on that. We had heard that Senator Bernie Sanders was looking to subpoena the CEO, but he has now agreed to voluntarily testify on September 24th.
Yeah, about the difference in pricing in the U.S. and elsewhere. Meanwhile, the race for more obesity drugs is continuing. There's a smaller company called Altimmune that is trending today as they have some developments on that front.
They do. They have phase 2 results talking about their GLP-1 drug, which they previously said had about a 15% total weight loss after 48 weeks. But the good news and the reason why they're up is that they seem to have solved one of the biggest concerns, which is lean mass loss. Only 22% compared to the average of all other incretins, which is what GLP-1s belong to, which is about 40%, and the fat loss is 78% of that. So that is the reason behind it. This is getting to be part of that market where we talk about differentiation. How do these other companies stand up to these market dominators? And what makes them different?
No more Ozempic face?
No
isn't
more.
That what it's called?
Yep.
And isn't that what we're talking about? The lean muscle mass going away?
All right, final ticker, Anj. We'll just put you through the races here. Teladoc moving higher. What was the news there?
Yeah, that's an interesting one. So Teladoc, they had merged with Livongo, which is this diabetes management platform back in 2020. They did a huge deal there, and that is what is coming to fore right now because they found through AI and a little bit of research that using that platform and using personalized nudges, for example, leads to greater engagement and leads to lower A1C levels. That's the diabetes insulin numbers that the diabetics look at. So that has been something that is really contributing to the growth in Teladoc's interest. As we know, they've suffered through sort of the waning interest in telehealth alone because of post-pandemic world. And so now with this, it really boosts their enrollment in chronic care management. So half of Teladoc's enrollment from last year alone was diabetes focused, and they said they have more than 1 million in total on their chronic care platform. So this is really good news. Just as a reminder, Teladoc acquired Livongo for $18.5 billion in 2020, but then still logged a loss of $13.4 billion in 2022 because of Livongo's sliding valuation. So this is looking to still build up on that platform, and they're still sort of sticking to it.
All right, Anj. 3 tickers in like 5 minutes.
I know. Did I do it fast enough?
That was impressive. Impressive. Thank you, Anj. Coming up, we're going to check in on some of today's top analyst calls, more market domination on the other side.
Paramount, the latest media giant to announce price hikes to its streaming service, Paramount Plus. Its plan will Showtime will now cost $12.99, and its Paramount Plus Essential option will be $7.99 a month. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Sitting Managing Director Jason Bazinet joining us now to discuss. I don't know how essential the Essential plan is, and Paramount has a lot bigger fish to fry, it seems, than tinkering with the pricing of their streaming plans, Jason. I don't know. Where do they even fit in at this point?
Well, where do they fit in? I mean, I would just give you the big picture. If I sort of look at what the market is saying that Paramount is essentially going to be a niche app. And I think these pricing actions are sort of consistent with that. You can think of Paramount Plus being akin to maybe HBO in the linear days. I'll just give you one sort of metric we follow. In the old linear days, you paid about a penny a minute to watch linear TV. Netflix today, the consumer pays about a half a penny a minute. And even before these price hikes, Paramount was about 2 cents a minute. And so they're just positioning this as a niche product, driving towards profitability. Where do they fit in the broader ecosystem? I mean, it's certainly going to be challenging to be sort of the old Paramount, but there's still a role for niche players.
And I'm just curious, Jason, what kind of, as you look ahead, 6, 12 months, I know you have a buy on the name. How much of that, Jason, is because you think, ultimately, this is an acquisition target and Sherry Redstone is going to make a deal?
Yeah, it's certainly embedded in our valuation, but I can tell you if you look at those deals that were talked about, either Skydance or Apollo back in the old days, there wasn't a tremendous amount of upside from M&A. There was some upside, but it wasn't a huge amount. And so do I think this asset, gets sold? Yeah, I do think it gets sold. Will it go for a premium? Yeah, probably will. But it's sort of not the core tenet of our thesis. What's really happening is investors are just glomming onto everything that's tech related, everything that's growth related, and have just left a lot of these legacy media companies for dead. I don't think it's that bad.
You don't think it's that bad. So among those that are not that bad, what do you think is sort of the most overlooked that you would encourage investors to take another look at?
Well, I would just say if you looked at the traditional media companies, their multiples right now are sort of almost like newspaper multiples, right? Roughly 5 times EV to EBITDA. Warner Brothers, I would certainly put in that camp. Even Paramount, I would put in that camp. The question is really, the way I would frame it for investors is all of these companies are generating cash flow. All of these companies are using their cash flow to pay down debt. What's happened, and that should accrue to the equity value, what's happened over the last 2 years is the multiple is compressed. And so the question here is, can the multiple compress further? We've gone from 8 times to 7 times to 6 times to 5 times. At some level, the multiple compression stops. And then I would also say that with these price hikes, what's going to happen is these streaming services are actually going to begin to generate profits.
So let me ask you, Jason, bottom line, what will be the top streaming pick for you in 2024? Because a lot of people, Jason, listen, they'd come on the show, they'd pound the table for Netflix, the king, the king, right? The war's already been fought and won, but I know you don't believe that. You have a neutral on Netflix. So what would you say, Jason? Give us the top pick.
Well, let me just give you, if I can, just give you the framework for what's actually happening. I've run this by a lot of institutional investors, and they agree. What's happening is PMs are way overweight Mag 7, right? And they're a little bit nervous because Mag 7 has worked so well. And so what they're doing is they're turning to their analyst and saying, give me a tier 2 tech stock that's not a Mag 7 stock. And they all the analysts come to the same conclusion, right? Which is, you just go buy Netflix. And so what's really happening is that the multiples and the stock performance of some of these streaming, I'll call them tier 2 tech winners, is really disconnected from the fundamentals, from the narrative. And it's really just sort of the afterglow of the massive performance of Mag 7. So what would I say? I would say we're probably in the early stages of sort of mean reversion. When will that end? It's, whenever Mag 7 stops working, right? That's going to be sort of the answer.
Well, it's been working less well, but that's just for a few days now. So we'll see if that ends up lasting,
yeah, we'll see.
Jason.
We'll see. That's right.
I also wanted to ask you specifically about Disney, given Inside Out 2 at the box office, and that seeming to be have a big take there, which obviously shows that some people are still going out to the movies. So do you think that also adds to the investment case for a legacy media provider like Disney?
Well, we're restricted on Disney at the moment. What I can tell you broadly for the box office is we have been slowly crawling our way back to sort of the golden $11 billion of domestic box, which is what it was prior to COVID. We're sort of stuck at sort of the mid-8s this year. And I think that's just a function of poor movies coming out. I don't think that there's a secular bear case on theatrical, but Hollywood's going to have to make better movies. And so I think, probably 25, 26, we'll get back to that $11 billion number. And that'll be good for everyone in Hollywood. It'll be good for the exhibitors. But it's just been a lot of bad movies have been made.
Jason, always great to have you on the show. Thanks for joining us. Appreciate it.
Yeah, you bet. Absolutely. Thank you.
Now let's get to some of our top analyst calls of the day. Goldman Sachs resumes coverage on a firm, giving it a buy rating, slaps a target price of $42 on it. So you need to buy a firm, Julie. That's according to Goldman.
Yeah.
They say this one's a buy. I think here's the money quote that they were telling their clients. We view Affirm as the leading provider of modern credit solutions for consumers with a diverse portfolio of products for point-of-sale financing and everyday spending. They talk about the company's strength in underwriting compared with some of those fintech peers as well, which they obviously think is a real advantage.
Yeah, and that's something that Affirm itself has touted as well, their underwriting prowess. In other words, that their portfolio is safer than some of their competitors. At least, again, that has been the selling point, one of the selling points for Affirm. And, it looks like the folks at Goldman achieved there. They talk about the company's strong track record of achieving well-managed credit outcomes despite growing faster than peers. Also, Goldman kind of looks into the total addressable market of BNPL, buy now, pay later, overall, and finds that it's going to grow, and then Affirm is going to take more market share within that space.
Yeah, it has been a rough ride for Affirm so far this year. Stock's down about 30%, but clearly Goldman sees that as an opportunity.
Weren't they up a lot last year, as I recall?
Pull back the chart, it's impressive. Over 12 months.
Yeah, what, 400% in 2023?
Big ride, yep.
So I guess it's all relative, right? Let's also talk about Anheuser-Busch here. That stock was upgraded to buy from neutral over at UBS here, and the price target on that one going to 72 euros. So this is you're looking here at the U.S. shares, but they gave it the euro price target of 72 there. And they talked about the cash returns as being positive for the company, or that the company will be able to return cash to shareholders, and that'll be a positive.
Yeah, they see this inflection point coming when it comes to growth and margins and cash returns. And really, to your point, that's where cash return story sort of takes hold. They tell their clients, I think the investors are going to be kind of place more emphasis on that attractive free cash flow yield. UBS is not alone, by the way. Most analysts covering Bud say it is a buy here.
Yeah, the stock down about 6% this year.
Still to come, it is the latest edition of our series, Goodbye and Goodbye. We're going to take a deeper dive for 2 stocks to help you make the best moves for your portfolio. Stick around, more market domination overtime after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking into the sales and marketing software landscape. And we've got a special treat here today. RBC Capital Markets software equity analyst Rishi Jaluria is with us. Usually we talk to you remotely from the West Coast. So it's a pleasure to have you here in person.
Wonderful to be here. Thank you so much for having me.
Yeah, so let's get to it here. Let's talk about the stock that you think is a good buy right now, and that is HubSpot. Now, HubSpot up about 13% or so over the past year. So let's get to why you like it. You talked about, first of all, that it has sort of a single platform approach. Why is that a strength for the company?
Absolutely. And, look, for those that don't know HubSpot very well, it's effectively like a Salesforce, that it does sales, marketing, service, commerce, operations. However, in contrast to Salesforce that has grown through acquisitions over the past 10, 15, 20 years, HubSpot built all of these on one single platform. That means it's one user interface, one single source of data to do all of these different functions of what we call the broader CRM ecosystem. I do believe that having all of these applications built on one platform versus disparate platforms is a really big competitive advantage, especially when it comes to Gen AI, and I know we'll talk about that in a second.
So, and basically it's simpler.
Exactly.
Okay, gotcha. And then if we talk about multi-products sort of built on that single system, you think that's also an advantage for them?
That's exactly it, right? Because these things are so woven together really nicely and organically, they're seeing great success with multi-product adoption, that customers that started on marketing are now using sales, they're now using service in ways that they weren't doing before. And at the same time, they are moving up market, where customers may have started and then moved on to Salesforce. They don't do it anymore. They grow up, they become big customers, and they still stay on HubSpot.
Interesting. All right, so let's get to what you talked about, and that is the Gen AI part. You like their Gen AI roadmap. What is their Gen AI roadmap? How are they using it?
Yeah, to me, what's really important when we think about software companies' AI strategies is, are they bolting on AI, or are they fundamentally re-architecting and changing the way their software works to be AI first and AI native? And that's exactly what I see out of HubSpot. I would argue they have probably one of the most impressive AI roadmaps of any company in front office application software. You see new use cases that you can unlock from it. You get new insights into your data, pipeline build, opportunity generation. These are not just making you more efficient, but making you effective in ways you could not do in a pre-Gen AI world.
Gotcha. We always talk about what a potential risk to the upside here. And in this case, maybe what do you mean by tech ceiling to enterprise ambitions?
So what that means is, what if there's a certain limit of how big customers can get that they can go after, right? Because that's really where the opportunity is large enterprises, right? Fortune 500, Global 2000. HubSpot absolutely has their hands full attacking SMB and mid-markets today, but over time, I can imagine their ambitions are to go into the enterprise. Remember, Salesforce began it as an SMB tool, going after the behemoth that was Siebel, and look where Salesforce is today. I can see HubSpot do the same thing, but it is really important that their technology can scale, and they have those enterprise-grade features and functionality that really large companies like ours actually need.
There's one more thing I have to ask you about HubSpot, and that is, it has been an acquisition target, right? There's been a lot of chatter around the company. There have been some questions. How does that sort of play into your thesis?
To be quite honest, I actually think HubSpot could become a much bigger company on its own rather than getting swallowed by a larger company. The rumors have been out there around Google. And while I think Google would love to own this asset, this is a top tier asset in enterprise software. I do not believe the regulators would allow it. They would not allow Google to make their largest ever acquisition, right? It would be $40 billion to get this deal across the finish line. YouTube was a $1 billion acquisition. That's been really controversial in retrospect. So I don't think a deal happens, but I think it's actually better for HubSpot long term that they go at it alone.
Interesting stuff. All right, let's get to the stock that you do not like here, and that is ZoomInfo. And now ZoomInfo shares are already down more than 50% over the past year or so, and you still think it's not a good buy. So let's talk about why here. Some of it is macro. Now, why is macro affecting ZoomInfo more than perhaps some of their competitors?
I think there's a couple reasons for that. So for those that don't know ZoomInfo, it's primarily contact data to help salespeople better reach targets.
Like lead generation.
Exactly,
kind of
lead
stuff.
generation. And this was super, super important during the heydays of 2020, 2021, when there was no such thing as bad spending in software. Things have changed since then. And so macro, I mean, if you can imagine, they're very, very exposed to the software vertical, to tech, to startups, and that's where we've seen a lot of the layoffs happening. And at the same time, as every company is trying to pivot themselves more towards profitability, that means their focus is more on growing with existing customers rather than landing net new logos, which is the bread and butter of what ZoomInfo is used for.
Gotcha. And they're fighting for that pie with other companies.
That's exactly it. The competition is getting a lot worse. 3 years ago, we used to talk about how ZoomInfo had the best depth and breadth of data, and I think competitors have significantly caught up to them, most notably Apollo, which is in this space, and then HubSpot actually made an acquisition in this space as well, and I can imagine they're just going to give it away for free to their large existing customer base. ZoomInfo is an expensive product. I think their list price is $10,000 to $15,000 per user per year. Effective price probably a lot less than that, but that is going to put a lot of pressure on them. And then at the same time, when their competitors are getting better, I think that's a tough combination for ZoomInfo.
Well, and then Rishi, the other thing is we continue to have this debate over what AI could potentially replace, what Gen AI could replace. And you think maybe ZoomInfo might be on that list?
I think that's absolutely right. Look, LLMs are really good at scraping the web. That is what they do. And that is one way in which ZoomInfo gets their data. And look, I live tested this. I used one of the LLMs out there and I said, with my prompt, I am an AWS sales rep. Who are the 10 people I should reach out to at General Motors? And it gave me their names, titles, and LinkedIn profiles. Ooh. It's really hard when I can do that for free with a publicly available LLM to pay however much ZoomInfo costs.
What could go right for Zoom? I mean, because this seems like a pretty negative scenario here, but what could they do?
I think the big thing they need to do is build up the stack, right? They have this data asset that was differentiated. Maybe it's getting more commoditized, but if they can use the large install base they have and all the data they have and build, I think, really useful value-added applications on top of that. Think about, how AWS went up the stack and built all these functionality on top of the core storage and compute. I think if ZoomInfo could do that, that could turn things around. I have not seen evidence that ZoomInfo knows how to build really good software yet.
Interesting. Well, we'll be watching for any of that kind of evidence. And just to be clear for folks who are watching, you don't have a position in either.
That's right. I'm not allowed to own any of these.
Good to know here. Rishi, thank you so much. Buy HubSpot. Avoid ZoomInfo right now. Again, great to see you in person.
Great to see you. Thank you
for coming in. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern. Josh?
Thank you, Julie. And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. And stay tuned for an exclusive interview with Treasury Secretary Janet Yellen at 4:40 p.m. Eastern today to discuss a new slate of initiatives to support housing development. Don't go anywhere. Market domination overtime coming up next.
Suddenly drops double digits.
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalyst.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Are you intrigued by the final frontier? You're not alone. But the space race isn't just about landing on the moon or even tourism for the wealthiest people in the world. It has the potential to gather and distribute vast amount of data, and it could even be a manufacturing hub for your favorite products. We'll chat with advocates and enthusiasts about why space is a real investment destination. From Starlink's biggest competitors to the perils of space junk, we'll bring you top insights. Join us for Yahoo Finance's Space Race, Investing in the Final Frontier. Don't miss our exclusive coverage starting June 24th.
There's the closing bell on Wall Street, and now it's market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where we end. That is where the major averages close the session here. We've got the Dow up by about 260 points or so, about 2/3 of 1%. But we see a big divergence again today. We talked about it earlier here, though we continue to see some weakness in tech. That's why the Dow here is outperforming. It's not as heavily weighted in that direction. We've got the S&P 500 down 1/3 of 1%. The Nasdaq down by much more, 1%, in part because of what's going on with Nvidia. And then lately, as we've been checking on that S&P equal weight index, it too is outperforming by a pretty broad margin today, which gives credence again to this argument that perhaps the rally that we are seeing is broadening, although the S&P 500 itself is not higher today. The Russell 2000 also higher in today's session. That prompts me to take a little stroll on down here to the 10-year, where we continue to see it around 4.25%. Remember, the conventional wisdom has been that these small caps will really be able to start to take off in a more decided fashion when rates come down. Jared, you've got a closer look at today.
Yes, well, another day of divergence between the Nasdaq and the Dow, as we've been talking about, kind of been a theme for the last few weeks. But let's check out the sector action today. And here we have energy up 2.53%. That is in the leading spot, followed by utilities with about half those returns, then staples. So kind of a defensive sector to the bullish action today. And what did not work? Well, tech, XLK down 2.44%, and then consumer discretionary, which also houses Amazon and Tesla. And you can really see what's at work here when you look inside the Nasdaq 100. Full of those techie growth names, you're seeing a lot of underperformance today, especially in the chip space. So let me just switch over to our semiconductors heat map, where we see Nvidia down over 6.5%, Taiwan Semi down 3.5%, so is Broadcom. ASML almost there, Qualcomm down 5.5%. So this also happens on a day when XLK, this is the first day of rebalance that happened after the close on Friday, when all those $10 billion of Apple shares were sold, $10 billion of Nvidia or thereabouts were bought, and the net result is, and that could have happened over a week, but the net result is we're seeing stuff down today. Now, here are the leaders, and in the first spot, we have cannabis. That's the MJ Harvest ETF. Then we have small oil. Then we have regional banks. So some interesting stuff there going on at the top. Also biotech up about 2%. To the downside, I'm going to leave you guys with the crypto board. There's another area where we're seeing a lot of losses that are pretty heavy. Bitcoin down 7%, guys.
Jared, thank you. Appreciate it. Markets finishing the day mixed, with the Dow hitting its 5th consecutive session of gains. Here to help us break down all of today's market action is Brian Levitt, global market strategist at Invesco. Brian, it is good to see you. And I want to start on one topic, Brian, that's certainly getting a lot of attention, which is Nvidia, which is taking a breather here, Brian. And, I think a lot of investors are just wondering, can the market keep rallying, Brian, when you have a giant like Nvidia hitting the pause button here? What do you think?
Yeah, I think the pause button's a reasonable word for that. Let's remember, we've seen an unbelievable advance in that name. I mean, the irony is that when Nvidia was leading, or a handful of names were leading, people were bemoaning that too, hoping to see a broadening out. So if we do continue to see this broadening out in the market, that's actually a healthier environment. That's a better backdrop. So, I believe that if the Federal Reserve can successfully normalize the yield curve without, any type of recession in the United States, which doesn't appear to be in the cards, that should be a good backdrop for risk assets, even if a couple of names at the top, which had moved substantially, need to cool off a little bit here.
I mean, Brian, that said, there has been a little bit more noise being made by folks who watch the Fed that the risks now are more weighted to them acting too late, and that the risks of a potential recession are rising. How worried are you about that?
Well, I'm not overly worried about the risks of a recession. I mean, when I look at the indicators that would suggest to me if we're having a recession, I would expect to see corporate bond spreads or yields relative to the risk-free rate blowing out, banks tightening lending standards significantly. So we're not seeing that. We're just seeing signs of slowdown in the real economic data. But I do agree that the risk is to growth, not to inflation. I mean, the inflation story is passé at this point. And so, yeah, I would like to see the Federal Reserve start to ease. I believe that 525 to 550 Fed funds range in a world where their preferred measure of inflation's at 275, well, that's just too tight. And it's time to start bringing those rates down. Again, I've told people before, they don't answer my phone calls, but I certainly expect to start seeing that as we move towards the end of this year into next year.
And Brian, what if they don't ease, though? Would that change your view of the market and where we're headed in 2024?
No, I don't think that, certainly not in the near term. I think the Federal Reserve, to me, whether it's September or December is largely immaterial. It's more that the easing cycle is commencing. Now, the longer they wait, the risk to the economy is larger. But the good news is there's not a lot of leverage and a lot of excess in this economy. So even though we've been inverted now on the yield curve some 19, 20 months, the economy's been able to be resilient through that, again, because it's not a classic cycle. We don't have a lot of leverage. We don't have a lot of excess. So I don't think that, the Fed, whether they do it 1 month versus the other month, is necessarily the big risk. It's more that if they just misinterpret this environment and stay on hold, indefinitely, well, economy's slowing. It could likely use a little bit of help here.
Besides the Fed, the other big thing that we are watching, Washington related, is, of course, the presidential election. We've got a debate coming this week. We are going to be hearing from the Treasury Secretary Janet Yellen here on Yahoo Finance in just a few. And obviously, there's a lot at stake economically in terms of economic policy. What are you focusing on that front when it comes to the election?
Well, one of the things I'm trying to do is calm people's concerns about it. People tend to get very worried that something's going to happen in an election environment that is going to meaningfully change the economy or meaningfully disrupt markets. That's not how it works. If you go back in history, you'll find that most election years, the markets have done just fine. Volatility hasn't picked up significantly. And you've seen the only time you've seen markets underperform is really in recessions, 08 and 2000. So beyond that, the markets have done fine. I mean, what you want to hear now, I think they're both going to pursue a pretty America First agenda. I don't know if we're going to get a lot of details about that on the debate stage. You'd want to get a better understanding of where tax rates are going to be in a second Biden administration. But I think the bigger message to investors is that it largely doesn't matter as much as they expect it to. Even if you look at the last two elections, the performance from the days that Trump and Biden were elected in November 16 and November 20, the market performance of both through their first 900 and something days, trading days in office, is almost exactly the same.
So it sounds like, Brian, what you're telling clients when they're asking you is, listen, it's important, but what you seem to be saying is it's important, but it's one variable among many.
Yeah, it's certainly one variable among many. And when I think about markets, it's always, to me, what's the direction of the economy and what's the Fed going to do? And, right now, it's a global economy that's been fairly stable in aggregate. And the market, with some broadening out, seems to think that things are getting a bit better around the world. And you have the Fed that's likely to ease. So to me, that is more informative than whether I had a crystal ball right now to tell you who wins the White House, who wins the Senate, who wins the House of Representatives. I'd far rather have clarity around which part of the cycle we're in, the next most likely direction of the economy, and what the Federal Reserve is going to do.
Brian, thank you so much for joining us. Appreciate it.
My pleasure. Thank you.
And now moving on to what to watch Tuesday, June 25th. Starting off with the economy, the monthly S&P Case-Shiller Home Price Index report is coming out in the morning. Economists forecasting single-family residential home prices to slow by 0.4%, giving us more insight into the housing market as home buyers continue to get squeezed here by higher mortgage rates and inflation. We're also going to get a new consumer confidence print for June on Tuesday. That number expected to decline 2 points.
And moving on to the Fed, tomorrow we'll get piece of commentary from two Fed governors, Michelle Bowman and Lisa Cook. Bowman speaking in London about the perspectives on U.S. monetary policy and bank capital reform, and Cook will speak at the Economic Club of New York.
And finally, we're going to get some more earnings, including FedEx, Carnival, and Manchester United. FedEx reporting fourth quarter results after the close. Analysts will be listening closely for clues about its $6 billion cost savings objectives. The company grappling, with lower margin e-commerce growth.
Coming up, ARM Holdings is the latest addition to the Nasdaq 100. We'll speak with the CEO on the other side of the break. More market domination overtime coming up.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Nvidia's continued slide, dragging on the Nasdaq to start the final trading week of June and the final trading week of the quarter, by the way. Yahoo Finance's Josh Schaefer is joining us now with more on the trading day takeaways. Nvidia definitely a big part of the takeaways today.
Nvidia falling over 6%, and I don't think it's a surprise when you see that you see the S&P 500 and the Nasdaq also fall from their record highs and slip a little bit, because we really saw, you guys were looking at this earlier with Jared, today you saw decent participation sort of across the market, and some sectors certainly did well, but when you consider Nvidia's weight in the S&P 500 and also sort of the sentiment it has within the tech sector and within the chip space. When that stock goes down, it's just not surprising to see the market wag on a day like that. BlackRock had an interesting note out today sort of highlighting a chart that we've seen quite a bit over the last year, but sort of how tech has had an outsized performance dragging up the S&P 500. So what you're looking at here in purple is S&P 500 tech sector, light blue is the S&P 500, yellow is when you take tech out. So if you took tech out, you wouldn't have a lot of the gains over the last year, but on days like today when tech does fall and a large stock like Nvidia falls, it sort of serves the other way. It was interesting, BlackRock highlighted today that they're still overweight US tech stocks, and the large takeaway from that was because they still believe in the AI trade, and they feel like the overweighting of the AI trade is more of a feature, not a bug of the current bull market.
It is huge, Josh, just to see like whether that kind of like, as we were talking earlier, that show the baton can get handed off from Nvidia. I mean, it is interesting, Nvidia come under pressure like this, but it's not like the market falls apart. I mean, it hangs in there.
Yeah, no, you saw signs of the broadening of that rally today, right? When you look at sort of the rest of the sectors and what was able to outperform, you look at something like the equal weight index for the S&P 500, so that doesn't overweight Nvidia in the same way the cap weight index does. The equal weight was up today. It was up almost 0.7%. The Russell 2000, and sort of a different index that's looking at smaller cap stocks, was also up today. So you saw some participation. What I do think it is a reminder of, though, Josh, is with how big the big tech stocks are, yes, we've talked about how this rally could broaden, but it would be a lot slower of a chug higher if you don't have the mega caps helping you out. When you take the mega caps out, you need other stocks to perform significantly better in order to get there. It was interesting today, Morgan Stanley's Mike Wilson was highlighting that he just doesn't see the transition to a full broadening really set right now. And he highlighted something that a lot of people were talking about to start the year. Remember when we were talking about the broadening, and it seemed like everyone that came on the show was talking about the broadening that we were going to see in 2024. One of the base cases of that was sort of this economic resilience and economic data continuing to come in better than expected. Well, now we're about 6 months into the year, like Julie just said, and when you look at something like the Citi Economic Surprise Index, which tells you how economic data is coming in versus expectations, it's been going down pretty much all year. So if your base case was we're going to have a broadening because data is continuing to come in better than we thought, that's not really what's happened thus far. And so if that was one of your pillars, you're kind of losing that pillar, and so maybe it's harder to reason why a broadening should come.
It's so tricky with those economic surprise indexes, though, because for so long, economic data was surprising to the upside. So you could argue that economists said,
just shifted the expectations too high.
You know, we've been burned too many times, and so now then you're disappointing. But yes, I mean, a lot of economists are talking about that the data has, even leaving out the surprise part of it, that things are getting a little bit worse, and there are some vulnerabilities there, which you could argue could also argue for broadening in some ways, right? If some of those,
because then you get cuts.
Because then you get cuts, and some of the other groups, if you take away, I don't know, there are groups that perform better from a defensive posture that haven't necessarily participated. I don't know.
Mike Wilson likes healthcare, so there you go. But that would be sort of one of the plays that you're mentioning, I think, right? To that extent would be maybe, okay, things are slowing down, but you could
some people, that's
actually
interesting, he likes it. I've seen that healthcare is almost like, some strategists talking about, I don't know if Mike Wilson does, but I'm saying some think of it almost like utilities. They see it as Iron Man.
I was going to say, it's
seriously.
You play both sides of the ball,
offense,
right?
defense.
Just like Josh in high school football, both sides of the ball.
Was it
Utilities,
Cantro? Michael Cantrowitz
that was it.
Was healthcare. I think utilities was the one that also
that
he talked about. But yeah,
healthcare AI and then also a defensive play. I mean, it's hard. Yeah, maybe.
Maybe. Exactly. All right, Josh Schaefer.
Joshua, thank you. Appreciate it. Moving on, ARM Holdings getting added to the Nasdaq 100 today. The British semiconductor company will also be incorporated in several other Nasdaq indexes. Shares of ARM up nearly 140% since its public debut back in September. Renee Haas, ARM Holdings CEO, joining us now. Renee, it is good to see you, and maybe start on that news, Renee. I'm just interested how you think about it. What does it mean for ARM to be included like this? Do you see it, Renee, as maybe a kind of milestone for the company? What are you telling your team?
Well, thanks for having me. It's certainly a milestone. It's something we're proud of. The Nasdaq 100, that's an elite company. So for ARM to be included on it, it's a very, very cool day. The employees and company are excited.
And so as you have this day and you're excited, I am curious because there's been so much talk lately, Renee, about retail investors, right? We've seen some glimmers again in the market of the meme stock trade. I think Tesla is a part of this phenomenon as well with its retail stock, retail shareholder participation in its recent vote, for example. So how are you thinking about that cohort of people who are interested in potentially owning ARM holding stock?
You know, honestly, I don't think about it that much. My focus is really on the strategy, trying to grow the company. One of the things I love most about my job is that I'm usually having discussions about technology in 2026, 2027, 2028. Thinking about, the question you just asked, I understand the question, but it's actually not where I spend a lot of my focus.
Fair.
Renee, let's talk about one area I'm guessing is a focus for you, which is the mega trend of AI. Renee, we spend so much time on this show, of course, talking about it. Investors are very excited. And I know, Renee, you would argue, I'm sure, I think, in fact, the last time we spoke, Renee, you said, basically you can't run AI without a CPU. Can you just walk us through, Renee, how you think about the opportunity for ARM here? How big is the opportunity when we talk about this mega trend of AI? How do you quantify it, Renee?
Yeah, I think that, and I was around, during the dot-com era. In fact, to me, dot-com kind of started even in the late 90s with the browser and then the build out of the internet. To me, this is much more profound because what AI is going to do is that it is going to really, really change people's lives in terms of productivity, whether that's call centers that can become 100% automated, healthcare, bioresearch, where you can cut the research of a cancer drug from 10 years to 5 years to 3 years. This is all going to be capable with AI. And then every device that we use, the data center, the automobile, your PC, your smartphone, they all need to run AI. There's no quibble around that. And since 70% of the world's devices today use ARM, and they have to use AI on top of the ARM-based platform already, it's just natural that we're going to be involved in it. So it's something we spend a lot of time on, but I don't think it's hyped at all. I think it is going to be something that when we look back in terms of what the capabilities are and what it unleashes, it's going to be a momentous time in history.
Well, Renee, it's so interesting, the relationship between AI and ARM, because I got to tell you, coming up to the drumbeat of your IPO last September, when there was a lot of talk about AI, we were talking to a lot of analysts who were saying AI is not really the story for ARM yet, that it's still early. And so it seems, though, that you have been gaining a little steam in that area. So can you tell our listeners and viewers right now kind of where you are for ARM in that cycle?
Yeah, I thank you for the question. I think respectfully, the analysts maybe didn't quite understand or have an appreciation at the pace at which things were moving. There was a belief that AI meant you're running a large language model in the data center. But if you look 9 months later, we have an AI PC. We have ChatGPT 4o running on a mobile phone doing voice recognition, which is being done in conjunction with the cloud and the local device. You have Gemini, an AI tool that runs on your cell phone. Nobody was talking about those things a year ago. And to be fair, it's not because the analysts didn't understand it. It's just the pace that this is how this is moving. And by definition, because of all the investments taking place in terms of training, all that training needs to find its way into applications. And most of those applications will be in your handheld devices or your consumer devices. So I think even the analysts probably didn't have a sense of just how fast things are going. And one of the things we like to talk about is that software is moving far faster than the hardware. So I think that's the key learning that we've seen, and perhaps the analysts as well.
And Renee, let's talk smartphones as well. I'm going to just get your take because we've had analysts come on the show, Renee, and say, listen, they think AI is going to prove to be a real tailwind for the smartphone market, at least the premium segment. Is that how you see it, Renee? And what would that mean for ARM?
I think it will be a tailwind. Remember that these smartphones iterate every single year, and they add new and new technology, which puts a lot of strain on the system in terms of battery, performance, heat. Now when you have to run AI applications, in addition to all the applications you were running before, that's a complex design problem. It's also a problem that ARM is very, very good at solving. And since most of these devices are already ARM-based and the software runs on ARM, it's pretty natural that we're going to be in the center of all of that. So we're pretty excited about the tailwind, not just for phones, but for AI PCs. automobiles, consumer devices. I think all of them are going to see a tailwind in the next number of years.
Renee, it seems as though when you talk about the speed at which things are moving, that the speed has maybe moved a little bit more on the enterprise side, where we've seen an enormous amount of demand. On the consumer side, perhaps less so. And so I'm curious to get your take, because you're so enmeshed with this. What sort of the killer app on the consumer side could potentially be for AI, or the killer use case?
Yeah, I don't think we know yet is the honest answer. If you think about the move from 3G to 4G, a number of years ago, no one could tell you that the killer app was going to be, I now can order a car on demand, it'll know where I'm standing. Or I can now get a rental property at a very, very low discount, and I can find them all very quickly. But that's Airbnb and Uber. Those apps were unlatched with 4G. Now, when we think about AI at the consumer, I think first off, we need to get the hardware capable, which is happening, and then the apps will follow. But history has kind of shown that that's how the model tends to work. So I don't know that the killer app is out there yet, but I'm also very confident that it will be very soon.
Renee, it is always great to have you on Yahoo Finance. Thanks so much for joining us.
Thank you.
That is going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of this break, it's an exclusive interview with Treasury Secretary Janet Yellen. Our Jennifer Schomburger will discuss a new slate of initiatives to support housing development and much more. Stay with us.
Are you intrigued by the final frontier? You're not alone. But the space race isn't just about landing on the moon or even tourism for the wealthiest people in the world. It has the potential to gather and distribute vast amount of data, and it could even be a manufacturing hub for your favorite products. We'll chat with advocates and enthusiasts about why space is a real investment destination. From Starlink's biggest competitors to the perils of space junk, we'll bring you top insights. Join us for Yahoo Finance's Space Race, Investing in the Final Frontier. Don't miss our exclusive coverage starting June 24th.
Welcome to a Yahoo Finance special report. The Biden administration is making an effort to lower housing costs, announcing steps to make affordable housing more available as Americans face higher costs of living. Treasury Secretary Janet Yellen is in Minneapolis today to give further details about that investment, and she will join our own Jennifer Schonberger for an exclusive conversation coming up in just 15 minutes, 4:45 p.m. Eastern.
Yahoo Finance's Rick Newman joins us now ahead of that exclusive conversation. Rick, what do you make of the Biden administration's effort to boost housing supply, Rick? Why now?
Let's see. In 4 months, there is an election.
Is there an event?
Yeah, there's an event coming up.
Oh, that's it. Okay.
I mean, you know, many people would probably be surprised to hear that the Biden administration has been trying to do this all along. I mean, this was affordable housing was part of Biden's Build Back Better plan that he campaigned on in 2020. That was they couldn't get that through Congress, so it kind of died. But Biden has been doing a bunch of what you might call small bore things to try to move the needle in communities, let's say. And what Janet Yellen's doing in Minnesota this week, this is part of a blitz of Biden cabinet officials and other members of the Biden administration going across the country, holding community events in what the White House is calling the lowering costs agenda. So in case you're not aware out there, President Biden is out there trying to lower costs for you. So that's what affordable housing is about.
Make life more affordable.
Make life more affordable. And why might they be focusing on that? Oh, because inflation is Biden's biggest liability on the economy. So what Janet Yellen and others are going to be doing is going out touting, you know, bits of money from the infrastructure bill, from the green energy bill that are doing something. Rural electricity costs are coming down, whatever they can find. Is anybody going to notice? I mean, will this get through to anybody?
Yeah, the follow-up being, is it going to work, Rick?
Is it going to work? I mean, I kind of doubt it, but you have to keep in mind that this election is looking so tight that we've talked about this before. I mean, this is going to come down to a relatively small number of swing voters in swing communities in swing states. So if you can persuade 50 people here and 50 people there, oh, maybe Biden's doing maybe he actually is doing something to make your life a little bit better, that could be meaningful. I mean, it really is at the grassroots and the community level that this matters at this point. So that's why we're seeing this blitz this week. And I think we're going to be seeing stuff like this all the way up till Election Day in November.
And just to give a little more specifics here, what we're talking about in terms of the announcements today, $100 million over the next 3 years to support affordable housing initiatives. Also, Yellen is urging Congress to pass legislation to expand the low-income housing tax credit, which I guess good luck in this divided Congress,
exactly.
Right?
Yeah.
But the $100 million they can do. They don't have to worry about Congress to do that part of it. So you said that they've been doing some of these things at the margins all along. Has any of that helped? What do economists say about all of that?
I mean, so it's very difficult to answer the question because you have to go to the counterfactual. What if Biden had not been doing this stuff, and what if he had been doing it but not talking about it? But there's a series of focus groups run by this analyst called Rich Tao that I pay attention to, and he did one focus group in one of the swing states. I can't remember which one, and he assembled 10 voters. He records the thing on a Zoom call, and he says things to them like, is anybody in this group aware of anything President Biden has done on student debt? And people just look at the screen and nobody is aware of anything Biden has done on student debt or whatever the big issues are. Can you think of anything President Biden has done on infrastructure? And people just look.
But if you owe on your student loan and you didn't have to pay for a few years, how did you think that happened?
I mean, there's a big disconnect. My point here is there's a big disconnect between what Biden signed the biggest infrastructure law in a long time in 2021. He has canceled lots of student loans, even though the Supreme Court struck down the big one. He's done a lot of these smaller programs. And yet people don't know about it. And these are people who say they are voters who intend to vote in November, who just are not getting the message.
So what explains that disconnect?
I don't think anybody is entirely clear. I mean, it's a bunch of different things. There's so much clutter on the news. People don't know what to believe. Biden talks through mainstream media, but everybody's watching TikTok instead. But Biden has a communication problem for sure. And I don't know if it's that he doesn't scream loud enough the way Trump does, or it's something about his personality, or it's the mediums he's trying to work through, or that people are just tuning out politics. I mean, it could be some of all of the above, but Biden's just having a real hard problem getting people to know what actually has been going right during his term.
Well, let's talk more about all of this because for the first time this year, President Biden is leading or tied with former President Trump. So maybe some of this is starting to work. In a lot of national polls, we're seeing him come up and catch up. The president might have improving economic sentiment perhaps to thank. Compared to last June, Americans are 5 points more likely to say they're getting ahead or holding steady financially. Joining us now is Henrietta Trace, Veda Partners Managing Partner and Director of Economic Policy. Henrietta, it's good to see you. I would like to start with some of the announcements that Yellen made today on the affordable housing front. Do you think this does move the needle? And obviously, housing affordability is an acute problem in this country right now.
It is. And just to your last segment, it's exactly what the voters Biden needs are most concerned with. If you look at the latest polling data, number one for youth voters under the age of 30 is getting access to housing. And they feel like it's much harder for them now than it is for, somebody who's generations older than them. And you can see that in the data as well. People 60 years and up don't worry about housing nearly as much as the youth vote does. So I think we saw the first themes of this in the budget rollout back in February in the State of the Union address when he talked about providing a homebuyer tax credit. Secretary Yellen's going to continue that effort. I expect you'll hear about that more and more as we get into the election cycle. And, just on the polls, real briefly, we still have 9 points to go in the polls that are not correct right now, meaning the polls right now are 9 points off from what we're ultimately going to get in November based on historical data. And so there's a lot of time, a lot of movement that's still to come. And most of that won't happen till hopefully after the debate or after Labor Day.
I'm just curious, just bring out your crystal ball here. Do you think what's being announced today, if you were to place your bet, do you think it has a meaningful political impact?
I mean, honestly, I'm a little surprised that they're doing it today because it's abortion week. They need to get better at messaging, as you guys were just discussing. The difference between Biden and Trump, I think, is that the entire Republican machine is able to get on a single agenda item and talk about that for an extended period of time in coordinated fashion. Democrats are sort of all over the place. So here we are on the week that Dobbs got overturned. We're going to have the debate. We should be talking about that all day, every day. And now they're also rolling out housing components. So it sort of dilutes the message. And I think that's a communications problem that they're going to have to work on. But they're really trying to throw everything at the wall right now.
So, Henrietta, that's exactly what I wanted to ask you about, which is this laundry list approach that Biden takes. I mean, his economic speeches are pretty consistent. He just goes through all the bullet points. Here's what's working, as you pointing out there, out this week, trying to hit a million different things. If you were to advise Biden and he were to take your advice, what one or two things would he be out there talking about?
Well, the number one issue for the people under the age of 30 and independent voters after the economy and inflation is now abortion. We talked last time I was on the program about how immigration has declined as an issue, and that's been a real boon to a lot of Biden's recent gains in the polls. It's just become less of an issue as immigration has declined 54% versus its highs in December as the third straight month running. So they really need to pick a theme, focus on it consistently, make this abortion week, make next week housing week, and really target it as much as you can. But I do think that they are really struggling to break through to younger audiences in particular. And I think that's a big reason they're having the debate this week in the first place. They need to be in the same place Trump is to get the eyes that watch Trump to also watch Biden. That's just not happening for them. And that's why the polls aren't moving.
Okay, so let's talk a little bit more about young voters. The Biden administration is also they are going to reclassify marijuana, so the weed vote, if you will. Is this going to get through? Because believe it or not, from some of the 20-somethings I know, whether in the family or not, I hear like, hey, wait, what is Biden doing here? So it sounds like maybe they're paying a little bit of attention to that.
Yeah, absolutely. We were telling clients that was coming back in November, and it's been a really good performer for our investors. But this is an area where you have, I think the data is something like 65% of Americans support legalization of marijuana to at least some degree. It's a pretty momentous change. It's not sort of your grandfather's Democratic or Republican Party anymore. It's not a crazy situation for people to envision. So I think it's very popular. It also resonates with older voters over the age of 65 as well. And I think it's worth remembering that the reason Biden is winning older voters now for the first time in many generations is because it's not the silent generation. It's not the greatest generation anymore. These are, folks who went to Woodstock, and this resonates with them.
Weed for everybody.
Probably some younger voters as well. Although I guess people,
Definitely.
if it's locally, I don't know. New York City is just a bastion of weed everywhere at this point. But Henrietta, I also wanted to turn to the debate coming on Thursday night, of course, and I'm curious. I'm always curious, and Rick and I talk a lot about this. How much this sways people, these debates, and what in the debate sways people. And I'm curious to get your take on that.
I think the debate itself is going to be probably one of the lowest turnout debates in terms of viewership that we've seen in a while. It is June 27th. Everybody's on vacation. People are, flying out of the country. School's out. It's not going to be something that I anticipate is widely watched. So that makes the framing around the debate all the more important. And like I said, I'd sort of repeat my same refrain: make it abortion week. Make it one particular item, and then have Biden hammer that all day, every day at the debate. So that your media clips and your news clips that can go viral the next day are about one singular issue. Or for Trump, make it about something very, very specific that you can go viral with afterwards. Because I don't think a lot of people are going to be tuning into the actual event. It's all going to be about what comes from it, the lead up and the post.
So I think about the debate a little bit differently, Henrietta. To me, it's geezer fest. And everybody is going to be holding their breath to see, does one of these guys do some kind of face plant?
Oh, you don't mean people watching. You mean the guys on the stage.
Everybody.
All of the above.
It doesn't matter who's watching live, because it's whether something happens that becomes
It's almost like you're saying, Rick, it's almost like the way you're passing an auto wreck and you have to pause and look.
Yeah, but you're going to have a remote instant replay for the next 5 months if there's something there. So so the question really is, how important do you think, the risks of a senior moment are?
I think they're extremely important. I've been on the road for the last 2 weeks with investors across New York and London. This is a topic of conversation in every single meeting. The predicted sort of markets and the polling data right now is telling you that about 20% of the street believes that Biden just won't be on the debate, on the ballot in November. And there is a 40% block of the population that doesn't know if Trump is going to go to jail or maybe he could go to jail. People are confused. They want to see what's going to happen. And I think you're exactly right to say that the risks to both of them are very, very high, that you have some sort of senior moment that you never come back from. And that's part of why the Biden team decided to hold the first debate on June 27th in the middle of summer, because if something does happen, they have plenty of time to course correct. But also they really need to get the polls moving, and they need to put Trump in the same room with Biden so that people can contrast in real time and not rely on, a deep fake or an AI situation that you're getting from certain media outlets. And I think that's really the most important thing. You're highlighting exactly what I hear from investors all the time. Are both of these guys going to make it? Are we really going to see these two men be on the ballot in November? It's still a real question.
Henrietta, Rick, really great conversation. Thanks a lot. Appreciate it. Our own Jennifer Schonberger standing by now for an exclusive conversation with Treasury Secretary Janet Yellen. Jennifer?
Thank you, Julie. Secretary Yellen, thank you so much for sitting down with me. It is great to have you on the program.
Thanks for the invitation.
Housing affordability has become a major issue for Americans in this country. You're here today in Minneapolis announcing new initiatives on housing affordability, including a brand new Treasury program that would allocate $100 million over 3 years to help finance housing affordability. How quickly can Americans expect relief from these programs?
Well, these are things that are in our power now with the tools we have that I think will be helpful. But I don't want to say that there's a silver bullet. I think we look to Congress to do much more. President Biden has proposed a program that would lead to the construction of 2 million new housing units, which would really make a sizable dent in the problem that we face. but we want to use every tool that we have. And today we announced, as you said, $100 million from returns on investments that we've been making in community development financial institutions over the next 3 years. And that can make a noticeable difference. We're also calling on the federal home loan banks, which were chartered to deal with housing and promote affordable housing, to up their contributions, their use of their income to 20% of their income to help with the affordable housing situation. We made a few additional announcements today, things we can do to lower burden in one of our key housing programs, the Magnet Fund, and also to help housing agencies, local housing agencies, have access to reasonable, low-cost financing through the Federal Financing Bank.
It's not just low-income Americans, though, that are grappling with housing affordability. It's the middle class. So why not offer tax incentives to try to increase housing supply on the market, whether for home builders or investors who bought up so many of the foreclosures following the financial crisis?
Well, we agree with that. The most important tax incentive that we have, it's the most important affordable housing program, is the low-income housing tax credit. And there is a bipartisan bill that passed the House that we're supportive of. We'd love to see the Senate vote on it, that would increase the supply of these housing tax credits and boost affordable housing. So President Biden has also proposed a tax rebate for first-time home buyers, and interestingly, also for sellers of homes, many of whom have seen such a big increase in mortgage rates. They took out their own mortgages when rates were much lower. They have a reason to move, but having to buy a new house at current mortgage rates would really boost their housing costs. They're reluctant to move, and not much housing goes on the market these days. And this would be a credit also that goes to sellers that would help unlock the housing market.
Secretary Yellen, have you been to the grocery store lately?
I sure have. I go every week.
It's sticker shock, isn't it? No. I just, when you look at shipping costs, those have come down. Global food commodity prices have also come down, but food prices still remain high. I know they're not rising at the rate that they were last year, but they're still up 20% from pre-COVID. So should the U.S. invest in agriculture to boost the food supply in this country?
Well, I think largely it reflects cost increases, including labor cost increases that grocery firms have experienced, although there may be some increases in margins. Earlier today, I met with a group of CEOs, including the CEO of Target, and they explained and they've announced that they understand that households are struggling with costs, including food costs, and they have undertaken cuts in the price of bread, milk, diapers, other core purchases that are necessities for households. And I think that's to be applauded. I think that kind of thing is helpful. But I would be reluctant to agree that we should be involved in subsidizing agriculture.
So investing in agriculture. I want to ask you about your overall outlook for inflation. It looked like it was stalling in the first quarter. We've gotten some better readings here in the second quarter, namely that cooler May CPI reading. We've got another inflation reading coming on Friday. Do you expect inflation will fall at a faster rate as we go through the summer months and the rest of the year, or is it going to continue to be sort of a slower slog?
Well, I do expect inflation to come down. And as we get into next year, I believe that inflation will go back to the Fed's 2% target. But there's month-to-month variation. And one of the pieces that has been keeping inflation above the Fed's target is housing costs. The the prices, rental prices for new apartments have stabilized and in many parts of the country come down. But people who have existing contracts really only see changes in their rental prices when their contracts renew. And there has been a considerable run-up since before the pandemic. So it takes a while before people who have existing rental contracts see current costs fully priced in. And that's been holding housing cost increases above normal levels. I feel pretty confident that that is something that will come down over the next year and keep moving inflation down. And labor markets, while very strong nationally, are a little bit less tight than they were right in the aftermath of the pandemic.
So given your outlook for inflation, you say you do expect we'll hit 2% by next year, and the fact that Americans are grappling with high home costs, part of that is mortgage rates near 40-year highs. When do you think Americans could see interest rates come down?
Well, I'm not going to speculate on what the Fed is going to deem appropriate. They set interest rates in order to make sure inflation comes down, but also to keep the economy operating near full employment. And their projections suggest that most members of the committee envision that there will be some interest rate cuts later this year or next year, but it's really depends on how the data unfolds with respect to the economy.
If rates are held at current levels through December, do we risk sowing the seeds of a recession?
Well, that's something that the Fed will be looking at. As I said, the Fed wants inflation to come down, and they've made clear that when they gain confidence that we're on a stable downward trend, that they think it will be appropriate to cut rates. They certainly don't want to cause a recession when it's unnecessary, and that's the balancing act.
And you don't think a recession is in sight right now?
I think we've got a good, strong economy. Growth is, we grew very rapidly after the pandemic. Unemployment was very high. Rapid growth was needed and appropriate to get people back to work. Once you have an economy with an unemployment rate that's 4% or below, which is what we've had for, well over a year or 2 years. I mean, this is a 50-year record in terms of the strength of the labor market. You expect somewhat slower growth in the economy, but households, consumer spending remains healthy, investment's been strong. I don't see the basis really for a recession in the outlook.
I want to ask you about the Congressional Budget Office's latest estimate for the deficit. They now say it's going to rise by $400 billion more than thought to nearly $2 trillion this year. Given the CBO's latest estimate and the amount of treasuries that are needed to fund the deficit, how much longer can the Treasury maintain the strategy of financing using shorter-term bills without changing the long end? Is it a bit lopsided?
Well, so it isn't the Treasury's strategy to finance increases in the deficit or in debt issuance by using just short-term bills. Long-term issuance is increased, and if deficit projections continue to increase, issuance at the long end will go up as well. But the Treasury follows an approach it has for many years of making issuance of longer-term debt regular and predictable. And so it's not something that we want to suddenly change in a dramatic way. So if there's a shock to the economy, for example, when COVID hit, the CARES Act and later the ARP were passed, big increases in expenditure needed. As a buffer, what happens is that short-term debt, the market can absorb a lot of that, and that's issued, and then that debt is termed out over time, and that's what we would do. But it's not a policy to just finance by issuing at the short end.
Speaking of the CBO, they're projecting that debt will reach 122% of GDP by 2034. Are we headed for a debt crisis?
That's if we don't have deficit reduction, but President Biden has already signed bills resulting in $1 trillion of deficit reduction, and his 2025 budget proposes an additional $3 trillion of deficit reduction over the next 10 years. That's sufficient if you look at the budget projections to hold the debt to GDP ratio at more or less its current level, which is about 100%, would prevent that big increase that you just mentioned. So fiscal sustainability is important. I think we need to get deficits down to stabilize the debt to GDP ratio. I think the most important metric in judging sustainability is the interest cost of the debt. And the interest cost of the debt, even with higher interest rates, is at normal historical levels. It's something that if it stays here, if we engage in deficit reduction so that it stays at this level, I think we'll be on a fiscally sustainable course. So, next year we're going to see the expiration of many of the tax cuts that were built in to the Tax Cut and Jobs Act of 2017, and we have to make sure that we address that expiration in a fiscally sustainable and responsible way. President Biden wants to protect those earning under $400,000, let them keep the cuts, but he would raise funds in order to find ways to cover that so that it's doesn't just bust the deficit.
To your point, Secretary Yellen, what impact would Donald Trump have on our economy if he's elected?
Well, look, I'm governed by the Hatch Act, and I can't get into electoral politics. I guess I could just make a couple of policy-oriented comments, which is that the signature policy from the Trump years was the Tax Cut and Jobs Act, and it promised an investment boom, which really did not materialize. It gave huge tax breaks to corporations and to wealthy individuals, and it resulted in an enormous increase in the deficit and lowered tax revenues below historic norms. And I think it's responsible for many of the problems that we face now with our fiscal trajectory. And so that would concern me to leave all of that in place.
I want to ask you about tariffs. The administration levied new tariffs on $18 billion of Chinese imports back in May. Does the administration think that tariffs could be a bigger tool in the toolbox when it comes to economic policy?
So we're trying to use them in a very targeted way. We've made a conscious decision, not only the administration, but also Congress, that there are industries that are strategic, that we think it's important to have a good base of activity in the United States. And I'm thinking particularly of semiconductors and also clean energy related items, whether it's electric vehicles, batteries, solar panels, wind turbines. At the moment, we're heavily, heavily dependent on China for most of these things. And China is following a strategy in which they are heavily subsidizing their industry to build capacity, and they've invested to the point of massive overcapacity. So China, for example, has enough capacity to produce solar panels that it well exceeds entire global demand. We have made, we have incentives for domestic producers to engage in this activity in the United States. It's something we think is important for job creation and for our security, supply chain resilience. And so we want to protect this aspect of our industry from what really amounts to Chinese dumping. So that's an area where we think there's a clear justification for protecting our industry with tariffs. And we're not the only country that feels that way. Many European countries and others, including developing countries, are really suffering from this Chinese strategy of producing overcapacity. But President Biden is not proposing to put any broad-based tariffs in place. Doesn't see that as a strategy that's desirable. And, with respect to China, he hasn't removed the tariffs that Trump put in place, but aside from what I mentioned these areas, hasn't increased tariffs.
Secretary Yellen, we'll have to leave the conversation there, but thank you so much for your insight. Hope to speak with you again soon.
My pleasure. Thank you.
That's Secretary Janet Yellen of the Treasury. I'll send it back to you in New York.
Our thanks to our Jennifer Schonberger for that exclusive conversation with Treasury Secretary Janet Yellen. A lot of interesting stuff, guys, out of that. Once again, joined by my co-anchor, Josh Lipton, as well as our Rick Newman, to talk about some of the headlines coming out of that. I thought it was interesting, Secretary Yellen talking about her confidence that inflation will come back down to the Fed's target of 2%, perhaps by early next year, by the close of this year. That was interesting. She is not concerned about the economy turning towards a recession right now. Rick, what stood out to you?
The number one thing that stood out to me is Janet Yellen does her own grocery shopping.
Yes.
So I think Jen Schoenberger's next assignment is to go grocery shopping with the Treasury Secretary.
She said she goes every week.
She said she goes every week. So Jen did not put her on the spot and say, well, how much does a gallon of milk cost? She could have done that, but I think it was gracious that she didn't. So I follow what Janet Yellen says, and I don't think she broke any news there. My fact-checking alarm only went off one time.
When was it, Rick?
It was when Jen asked her about the federal outlays for interest payments on the national debt, and Secretary Yellen said, well, they are at about normal historical levels right now. And if we can just keep them there, we'll be okay. I was able to find the data on this. They're only at historical averages right now if you factor in the 1980s when interest rates hit like 20%. Okay, there was a huge bulge in net interest costs as a percentage of GDP in the 80s because interest rates were so high. The rest of that curve is way below where we are right now. And what has been getting a lot of attention, I've covered this, other people have covered this, we are now paying more in interest on the debt than we are spending on national security, and we're spending almost as much on interest as we're spending on Medicare. I don't think that is sustainable. So I think that number has to come down in the future. Otherwise, we heard a lot of, she talked about the economy the way Biden talks about the economy.
Meaning what, Rick?
She highlighted what's going well, but there's more work to do. So she said affordable housing, no silver bullet, inflation, we're not going to get it down as fast as we want, but maybe by next year it'll be back. So, again, this is part of the Biden strategy, blanket the nation with cabinet secretaries spreading the word about what's good about the Biden economy and what they have yet to accomplish.
All right, Rick, thank you for joining us, by the way. That was great. For more reaction to our exclusive interview with Treasury Secretary Janet Yellen, we're bringing in Joe Brusuelas, Chief Economist at RSM, and Keith Lerner, Co-Chief Investment Officer and Chief Market Strategist at Truist. Guys, good to have both of you on the show. Joe, I'll start with you. Listen, I'll give you the floor. Joe, you heard that interview with Janet Yellen. What did you make of it, Joe? What were some of the big themes, the big trends you heard?
Well, I guess the big takeaway I heard is the message on housing, which the administration clearly is pushing ahead of this week's debate. They've got a very ambitious plan whereby they're going to put $100 million on the table in addition to sponsoring 2 million homes, construction of 2 million homes. Through the Fannie and Freddie Mae institutions, are able to offer $10,000 to first-time buyers, $25,000 to first-generation buyers, and they're moving forward to make rental assistance where they can out there for households that are under stress. I think that Secretary Yellen's always a very effective spokesperson. Anytime she talks, I stop and listen to what she has to say. And I'm in agreement. Our forecast in terms of the overall rate of inflation getting back to 2% is the fourth quarter of next year. but we've got disinflation moving through the economy, and I think we'll get some really nice data here at the end of the week, the day after the debate.
Yeah, indeed. She shared that optimism. And Keith, as you write in a recent note, you say the path of inflation and interest rates and whether the Federal Reserve can stick the soft economic landing will likely be more consequential than the election. I want to replay what we just heard from Secretary Yellen about her outlook for inflation.
I do expect inflation to come down. And as we get into next year, I believe that inflation will go back to the Fed's 2% target.
So what do you think, Keith? Do you share that optimism here? And then what are the implications for markets?
Yeah, well, great to be with you. It's an election year, so it's always an interesting time as a strategist. Well, listen, we do think we have disinflationary forces intact. We think inflation will settle probably a little bit above 2% because of things like onshoring. We think energy prices will probably stay a little bit higher as well. But the trajectory, we are seeing those disinflation trends. The one thing we're watching is to make sure it's more because of the disinflationary trends, not because the economy is weakening, causing more of those trends to soften as a whole. But we think all in all, we're kind of normalizing in the economy back towards a 2% economy, and inflation that maybe settles around 2.5%, maybe around 3%, somewhere in that neighborhood. So we're not that far off is the main thing. But the point you just made too is, the elections matter, but our work strongly suggests other factors in aggregate actually matter more.
I have a question for each of you guys. So short answers, please. But, Biden's got a closing window here in terms of improvements in the economy that voters will feel before they make up their mind to vote. So let's call it by mid-October. Joe, I'll go to you first. Do you feel like the economy is going to get appreciably better in ways that people will feel by mid-October?
I do. I think that the economy has a funny way of trumping ideology in politics, Rick. I think that 40-year or 50-year low in unemployment, 4% for greater than 30 months, 15.6 million jobs, that will resonate at the end of the day. Because when voters really look at what their economic conditions, they're thinking about, is my income rising faster than inflation? Yes. Do I have job security? Yes. And are things getting better? They are.
Keith, you want to take a stab?
Yeah, I say historically, if you don't have a recession in the few years before an election, you normally get reelected. I just wonder if it is different this time, where there's just different policy views of the American people that may change things, because I don't think the economy is going to get stronger from here. I think it's likely to just stay somewhat resilient, but normalizing, and the unemployment rate likely ticks up a little bit, so still resilient. So I just wonder this time if that's going to be the same game changer that it has been historically, but historically that has been the way it's played out.
Guys, I'm also curious, Keith, I'll send this one to you first. I know we look at typical election patterns, and I know we always hesitate to say this time is different, but you have had people around former President Trump, as well as him himself, sort of laying the groundwork for potentially not accepting an election result if it doesn't go his way. If you did get unrest, if you did get a repeat of a January 6th type situation, does that then end up affecting the markets and the economy sort of? And as a strategist, Keith, is that something that you even think about at this point?
Oh, I think about it. I think the reality is, though, you brought up January 6th. I mean, so markets could sell off around that uncertainty and around the election. Is that going to go on for weeks, a month? But is it going to go on for 6 months or a year? And if you think about investing in the equity market as an example, you should at least have a 3, 5, 10-year time frame. So yes, it can cause a sell-off. Look what happened overseas recently with India and Mexico and France. So we could have a short-term reaction. But I think ultimately, once corporations know the rules of the game and who is president, they will adapt. That's why, more than anything, I have confidence in our corporations. And again, I think the business cycle, as mentioned earlier, will have a bigger impact. And that's not going to just change overnight because what happens in November.
Joe, this one for you. When will markets start pricing in possible election outcomes, and what are they going to be trying to price in?
Okay, so I don't think that they are, Rick. That's the thing. And when the time comes, they're just going to be pricing in likely whether there's going to be a tax cut, if there's going to be tariffs, or if there's going to be other large-scale changes to the global and domestic economic framework. Period. End of sentence.
Keith, final one to you over here. Obviously Biden and Trump they don't agree on much, but there is some kind of common theme there, Keithy, here when it comes to trade. There's sort of increasingly protectionist rhetoric and policy. And, Jen Schonberger did ask Janet Yellen about those tariffs, and Yellen talking about how we try to use them in this kind of targeted way. I'm just interested, Keith, how you think about that as a strategist, tariffs, the effect on the economy and the markets.
Well, they do have an impact. I mean, it can be somewhat inflationary. We don't make wholesale changes. I think it could affect, like if you think about this election, it could affect how you think about investing internationally. It could impact how you think about China. You could think about, Mexico as an example. And I think going into the election on either side, like China may be a punching bag for both sides. So you may say, hey, as we get closer to the election, you're probably seeing more negative rhetoric on China. That's not the reason why we're avoiding it. We are underweight and we don't like China for other reasons, but that's just one more factor on top of that. But one thing also I just want to point out, a lot of times ahead of these elections, there's so much discussion about the different policy and how that's going to affect all these different sectors. We just did some work with that. The top sector under both Obama, Biden, and Trump has all been technology, because that's where the innovation is, right? And when Biden came into office, a lot of people said that energy and financials were going to be the worst sector because of regulation and so forth. And those are the top three sectors as well. So again, I just say this is one factor out of many. It's important. But again, the business cycle normally is even more important than just who's in the White House, even if there's tariffs that are more sharp than one party or the other.
We shall see, gentlemen. Thank you so much for joining us, giving us your reaction. And Drew Bruce Willis and Keith Lerner, thanks for your time.
Thank you.
Thank you.
All right, let's recap some of the key remarks from Treasury Secretary Janet Yellen's exclusive interview with Yahoo Finance's Jennifer Schonberger. She talked about sharing the Fed's optimism, or talking about her optimism that we're going to see inflation come down. She talked about deficits and sort of trying to keep those deficits capped as well. And she also, interestingly, talked about the sort of signature Trump economic policy, which was the Tax Cuts and Jobs Act. She said that it promised an investment boom that did not materialize, which I thought was interesting here. Is that a fair assessment?
So. I think so. Now, you have to add a caveat, which is, well, COVID arrived in 2020, so the tax cuts went into effect at the beginning of 2018. So you weren't going to see a boom in 2018. I mean, the idea was that the trickle-down idea, the supply side was, well, as businesses enjoy this basically lower cost of doing business, they will reinvest more. That never did happen. The Trump explanation would be, well, but COVID happened, and then we had all this fiscal stimulus that just stomped on everything. But I think she's generally right. There's not a lot of evidence that those big tax cuts accomplished what the Republicans at the time said they would. And important to point out, what's coming up at the end of 25 is the corporate tax cut stays in place. That was permanent, so that's at 21%, and that will not change unless Congress passes new legislation to change it. But all of the individual tax cuts expire, and that is going to be one of the biggest issues for sure after this election is over.
Yeah. It was interesting because you sort of had this generally optimistic, strong, confident tone about inflation, the economy. See what Biden can carry that forward on.
That's Janet Yellen. She's the grandmotherly, everything's going to be okay. You practically think she's going to serve you some chicken noodle soup.
Matzo ball, please.
Okay, matzo ball. Yeah. Rick, thank you so much. It was great having you. It was great having you here today. That is a wrap for our special coverage of an exclusive interview with U.S. Secretary of the Treasury Janet Yellen. Be sure to come back tomorrow at 3 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.